Welcome back, folks, ladies and gentlemen. Yes, we're not outside the Arsenal football stadium. We're inside. No, just kidding. Just a cool backdrop behind me. I don't know whose football field that is. It looks like the Arsenal colours. Anyway, Greg Silverman here, Outsource Chief Investment Officer, Outsource Chief Financial Officer, curating one of our articles that went out last week in a Come Learn With Me session. So this one did well. Let's read it together. U.S. housing market is at a crossroads. Moody's concludes that the incredible home price boom is over. And this is a little under a month old. Reports released this week by several respected market observers point to less good and increased bad and ugly ahead for the housing market. Interesting. This is interesting from a psychological point of view. You see how they don't say terrible, bad, or prices are going down, but it's less good. It's not bad. Okay, it's increased bad, but it's not terribly bad, and ugly. Well, ugly we can add. So still a positive slant, let's say. For some of the good, U.S. Census Bureau report released last week spurred about optimism when it revealed that new home sales jumped by nearly 11% month-over-month in May on a seasonally adjusted basis after declining 12% in April. Moody's Investors Service, in a housing market report released this week, put some ugly back into the home sales figure for May, however. Put some ugly back, just some ugly, not a lot, just some. At 696,000 units, May new home sales were around 70% below the recent peak of 839,000 units in December last year. The Moody's report notes on June 21. The National Association of Realtors said that existing home sales declined for the fourth consecutive month. Existing home sales fell in May by 3.4% on a seasonally adjusted basis to 5.41 million, the lowest since June of 2020, and similar to pre-pandemic levels. Those figures, along with the sharp recent increase in mortgage rates and other supporting data, lead Moody's to conclude that the U.S. home price boom is over. The firm, which rates securitization offerings and provides other capital market services, predicts material declines in both new and existing home transactions this year compared to 2021. Okay, well that's pretty negative. Material declines, so that is popping out there. The one thing that I wanted to say that I don't have any proof for this. This is just totally out of the blue, but I believe they're starting to discover a fair bit of fraud that occurred in mortgage applications, which is typically what we see near the top of the market. Supporting the ugly outlook for the housing market is the release today, June 29th, of the quarterly CFO survey. Oh, CFOs. Conducted jointly by Duke University's Fuqua School of Business and the Federal Reserve Banks of Richmond and Atlanta. The survey of more than 300 U.S. financial executives conducted between May 25 and June 10 shows optimism about the broader U.S. economy continuing to decline. Optimism is continuing to decline, folks. The average index score for the current survey is 50.7 compared with 54.8 in the prior quarter and 60.3 2 quarters ago. Price pressures have increased, real revenue growth has stalled, and optimism about the overall economy has fallen sharply, said John Graham, Fuqua finance professor and the survey's academic director. Monetary tightening by the Federal Reserve is one of several factors dampening the economic outlook. The CFO survey's findings are echoed by a revised first quarter 2022 gross domestic product estimate released Wednesday by the U.S. Department of Commerce's Bureau of Economic Analysis. It shows that a drastic economic slowdown is already underway. On that note, I just want to point out one thing. This is op-ed outside of this article. That comparisons, we're in earnings season now, which I guess would be Q2 earnings season. So year-on-year comparison. So if you go back to June of 2021, which was really outsized as things reopened and whatnot. So the comparatives year over year are not good because June 21 is probably larger than it should be, and June 22 is smaller. Hope you got that. Real gross domestic product, measure of all goods and services produced by the economy, decreased at an annual rate of 1.6% in the first quarter of 22. The BEA report states in the fourth quarter of 21, real GDP increased 6.9%. So that's kind of what I'm saying. Right, big drop off. The BEA's first quarter GDP estimate, its third to date, was revised downward from minus 1.4% and minus 1.5% in the two prior estimates. The grim data led Mortgage Capital Trading, MCT, a San Diego-based capital market software and services firm to broach the R word in a daily market overview report. Concern over a slowing economy and aggressive interest rate hikes from the Fed are beginning to dominate market sentiment, the MCT report states. The morning's GDP release on June 29 came with a downward revision for the last reading, further supporting views that a recession is either in progress or coming soon. What does all this mean? By the way, this is the most telegraphed recession I've ever come across. Don't know what that means. Contrary belief is that we're probably not even going to have a massive recession. We expect some increases in existing house prices over the 18 months, though for appreciation to be well below the general rate of inflation, Moody's report states. After that, we expect home appreciation to settle in at levels somewhat lower than the rate of overall US inflation. The report even indicates that there is a risk that existing home prices will have a minor correction over the next 2 years. Again, tiptoeing over that. Yes, they could probably very well be right. They probably will be right. But no one's predicting a massive bust in real estate, similar to housing markets in many other developed countries facing risks after recent moves. The moderation in the US housing, that's a word you're going to see a while, is ongoing, and the full effects of recent rate increases have yet to be fully realized. Moody's report adds, especially with respect to housing prices. Moody's predicts that housing demand will dampen significantly in the months ahead due to doubling of rates for 30-year fixed mortgages since the start of the year, which is fueling a huge jump in monthly mortgage costs. Freddie Mac's most recent primary mortgage market survey shows the average 30-year fixed mortgage at 5.81% as of June 23rd. The monthly cost of new mortgage on existing homes sold at median transaction prices are more than 60% higher than a year ago. Wow. Moody's report states, although higher mortgage rates do not always drive home prices lower, it typically affects sales activity and drive down the rate of price appreciation. So this is something I just want to comment on. Well, let's just read the next paragraph. We also expect higher rates to restrict for sale supply, because current homeowners will be reluctant to lose low rate fixed borrowing costs. Okay, yes, I believe that. I see many articles that say, well, now the cost of a mortgage is higher. Yes, I get that. And the cost of a home is much higher. I get that because of the boom. And as a result, home sales will decline. I get that as well. But what I think it fails to mention is some people who are over their skis, who levered up a bit too much on the housing side. That, if we have a slowdown and people start losing jobs or losing income, that's going to be a problem. And so in turn, if people, need to get out of their homes in a rush, prices are going to come down. And I just don't see that leap just happening just yet, but all the signs are there that that's what could happen. So in effect, moderating or even declining home prices can be neutralized by rising borrowing costs, leading the housing market towards stagnation, the doldrums in the worst case scenario. Okay, we shall see. There is some good news mixed in with all the bad and ugly, however. Moody's points out that some fundamental housing strengths will likely help to mitigate the degree of any market correction, at least over the next 12 to 18 months. Those strengths include favorable demographic trends, solid underwriting of outstanding mortgages. Okay, we'll see. This has been put to the test, and lingering house supply constraints from a period of underbuilding, according to Moody's report. Also on the bright side, according to Moody's, is that a moderate decline in housing prices could be good for the market longer term. That's assuming the Federal Reserve wins the fight to tame inflation, now running at 8.6%, without causing a major spike in unemployment, which was at 3.6% in May for the third month in a row, according to the Bureau of Labor Statistics. In short, the housing market has reached a fork in the road based on the Moody's analysis, with one path leading to the doldrums or even decline, heaven help us, and the other towards resurgence and a new normal. I don't know about a resurgence, but hey, we may get a period of resurgence now as interest rates start biting and growth starts slowing and inflation starts coming off. If US home prices were to decline modestly, it would increase affordability for potential home buyers and improve demand, including for individuals who were priced out of the market in recent months because of rapidly rising interest rates. Moody's reasons in its report. However, sustained large increases in mortgage rates or a material weakening in the labor market, that's what we've got to watch for, could lead to sharper decline in housing activity and prices. Okay, so they did say it at the end. All right, guys. Well, when it comes to homing, everyone is very passionate, and as are we. So great article. I'm glad that you'll like to share this one. We got a chance to read it on our Come Learn With Me session. If you'd like to know more of what we do, take a look at some of the links below. We can help you on the investment side. We can help you on the financial side. We can help you raise money. We can help you put systems into your company, modernize the company, get it ready for sale. We've worked with family-owned businesses that have required some upgrades to move them to more institutional type businesses that have sold at higher multiples. So take a look at the links below. Thanks for joining me. Greg Silverman. Out for now, Gov.